I would like to welcome Leo Strine and Rebecca Henderson. Leo is going to start with a 40-minute address and then comments, and then we will take questions. So Leo, take it away.
Good to be with you. I'm a little nervous. I'm always nervous to be with big brains. I saw an R on the screen. I thought people were going to talk about R squared and things like that guys like me who were born in Baltimore and grew up in Hocassin, Delaware don't know from, except for my fellow Hocassin man, Guhan Subramanian, who's a legend. But, and I'm also a little nervous because speaking for 40 minutes on Zoom from a prepared text without my presidential teleprompter is very difficult. But I'm glad to be with you. And I want to applaud the Institute and Columbia for focusing on this. I think for too long, this has been a topic that society, but actually the academy has really lagged on. The separation of ownership from ownership, as I've long called it, has been an important phenomena for decades now. And it has seismically changed the power balance within corporate governance. That's especially true in the United States, but it's also been a trend in the OECD and particularly in the EU, as the new commission report of the EU points out. Today, I'm going to talk about what I think stewardship actually means if it's going to be a meaningful concept in the 21st century. And I'm going to address why any serious effort to rebalance our corporate governance system and address growing economic insecurity and inequality must include regulating the power of all classes of institutional investors. And they're basically three primary classes: pension funds, mutual funds, and hedge funds. And put simply, to do this, what you really need is regulation that makes institutional investors do what's required of any faithful fiduciary and any good citizens of a republic. They have to take seriously their obligations of fidelity by aligning their conduct with the real interests of those whose capital they hold. And they have to make money for themselves in a way that doesn't cause societal harm. Now, for many years, stewardship's been more of a name in the investment community for blaming the people who manage real companies, the companies that make products and deliver real services, for every problem. But as a matter of linguistics, I think stewardship requires something more inward and responsibility accepting. True stewardship involves undertaking meaningful obligations yourself. In this context, it requires coherent investing, engagement, and voting policies that emphasize sustainable growth and that recognize that human investors need, and this isn't just an Alan Alda kind of, I'm dating myself, but he was a crunchy granola type from MASH. It's not just somebody who wants, quinoa instead of ground beef. They need, as investors, human investors need as an economic matter, companies that pay wages that are fair to workers and treat workers with respect. They need companies who avoid externalizing costs to other companies, taxpayers and consumers, and they need companies to be environmentally responsible. And institutional investors, if they're going to help promote that kind of conduct by companies, it doesn't just require them to engage in talk, it requires that they match that with action, and that requires discipline and focus. And today, I'm also going to talk about what moving toward genuine stewardship might mean if there's a new administration in Washington. To frame some recommendations I'll make along those lines, I'm going to start by identifying the difference between the corporate governance system we actually have now in the year 2020 and the system that existed when most of our regulatory structures addressing institutional investors were created. I will then touch on the unsatisfactory outcomes that have resulted during the last 40 years when the power of institutional investors and the stock market over American public companies grew enormously and the protection for other stakeholders shrunk substantially. And after that, I'll discuss why trusting the institutional investor community to reform itself is not an adequate answer. Finally, I'll finish with what a sensible framework for updated industry regulation might look like, emphasizing that this reform, while essential to restoring greater economic fairness, is not sufficient unto itself. Now let's start with why the corporate governance system we have is not your grandfather's. because we got to understand that if we want to actually make things better. Most of the regulatory structure that was set up was based on certain implicit assumptions. The first was that stockholders generally had a long-term stake in the company's best interests. Most stockholders were affluent. Most of them owned their shares directly for their own benefit, and they held them for a lengthy period of time, and there was relatively minimal turnover. The stockholders who were most active and vocal were those who had the longest term stake in the company. Most stockholders invested because they liked the companies and their management and did not interfere in the company's strategic direction. There were certain wealthy investors, I think of Thurston Howe from Gilligan's Island, and for young people, you can catch that on Nick at Night and answer for yourself the time-honored question, Marianne or Ginger. But Thurston Howe, people like that, were deemed to have so much money that without harm to society, we could let them invest in opaque vehicles on a caveat emptor basis, and we would deny those investments to less affluent investors who we thought couldn't take care of themselves. Then in terms of workers, workers were largely dependent on pension funds and Social Security for their retirements, and they did not form a large segment of the investor class. Most public companies had a long-term lender who had a deep relationship with the company and kept a sharp eye on its ability to pay its debt and to weather tough times. When companies profited, they tended to create more jobs, pay workers better, and give back to their communities. Corporations had a national and often regional focus, and their managers, directors, employees, lenders, and even stockholders often had thick ties of loyalty to those communities. Corporate managers lived in the best part of town, but they didn't live in a different universe. There was a plan of internal succession, and corporate managers tended to live right in the community, again, in the best part of town, but in the community, and to be deeply engaged in company affairs. Now, in recent decades, those assumptions have really been turned on their head. Corporate stockholder bases turn over rapidly. That's probably slowed a little bit with the growth of index investing, but average turnover among active traded mutual funds is basically 100%. Hedge funds and other types of funds trade even more frequently. Most stock now is not owned by individuals, it's owned by institutional investors, but it's not just for the affluent. They increasingly have the capital of American human investors. And these institutional investors engage in much more portfolio turnover than was common in the past. The actual human investors who are invest through 401k and college savings programs are largely bystanders and do not get to vote. The most vocal and active stockholders actually have investment strategies most in tension with the efficient capital markets hypothesis. That is, they are by definition the closest to irrational and needing a guardian. And in particular, the most active involve hedge funds who only become stockholders usually after deciding to change the company and have no prior interest in its well-being and no long-term interest in its well-being. Even the institutional investors who represent diversified worker investors, or some people call it universal owners, such as index funds, have pushed managed to the market policies and have pushed companies to put immediate returns first, even if that involves harm to other stakeholders. The growth of hedge funds and private equity funds has been fueled not primarily by Thurston Howe and other rich individuals who bear the risk of losses themselves, but by other institutional investors like pension funds, charities, university endowments, whose soundness is important to ordinary Americans and society as a whole. The voice of lenders as a stabilizing and risk-reducing factor has declined as corporate debt has been securitized, but without any corresponding increase in stewardship on the part of mutual funds and others who represent the investors who hold the risk of insolvency or downgrades. The tie between increasing corporate prosperity and the best interest of corporate workers has been eroded, with corporations not sharing productivity gains with workers and instead at the behest of market pressures, focusing on offshoring and job and wage cuts as methods to increase profits. Corporations increasingly have no national, much less community identity, and are willing to not only arbitrage their communities against each other in terms of seeking tax subsidies, but also to abandon their national identity for tax savings. Think of aversions. And top corporate managers have been promised pay packages way out of line with other managers. They in fact live in another part of the universe than most of us now. But in exchange for their lavish pay packages, they've been required to focus intently on total stock return, and they have to be willing to treat other corporate constituencies callously in order to keep their market employers happy and to reap the rewards of their pay packages. Now, under this radically different system that we now have, human investors are not citizens of the corporate governance republic. They're the voiceless and choiceless. And they are on the sidelines watching power struggles among the classes of haves, basically among the institutional investors themselves, who directly control the stock of the companies upon which our nation depends for its continued prosperity. And as I said, attention to this sector has lagged well beyond its power. Now, old tropes in some ways are responsible for this. Like there's some New Deal tropes, and it influences the Democratic Party, the party I'm a part of to this day, which is stockholders were good in this context under the New Deal paradigm, and management was bad. And that trope has persisted despite the change in identity of who the stockholders were. The focus of academics, the business community, and as I said, ironically, the Democratic Party has therefore tended to be on what bad managers were not doing for stockholders, society, or stakeholders, with little attention on the increased pressures public companies were facing from institutional investors. The obsession with agency costs that infatuated key academics like Dan Fischel and my friend Lucian Bebchuk, who you were honored to hear from earlier today, about company managers did not catch their fancy. They just weren't that into it. The assumption among these academics associated with the law and economics movement, despite their protestations to the contrary when anything went wrong, like the financial crisis, was that ECMH really meant that whatever could pump up the current stock price must be optimal, because the market and particularly institutional investors would price any externality risk. And if there's any harm, well, that government will come in and clean it up for everybody else. In focusing on individual companies, they ignored the fact that most investors are long the economy, they're long the economy, not one company, and that the sum total of externalities at specific companies and downward pressures on wages was less money for working investors to save, more economic insecurity, more taxes to pay, and more environmental and public harm. That institutional investors voted all their funds in one way, that means the socially responsible funds, the index funds, the active funds all voted the same way, even on stock for stock mergers. And that was okay, even though those funds had different objectives. That retirement investors got the same voting policies as quarter to quarter day traders didn't matter. Now, admittedly, some of us harbored some hope that in the institutional investor, consolidation, there could be some positive benefits. Maybe these mutual funds and index funds and pension funds that were long-term would actually put up directors as owner directors. And because they're stuck in long-term, and they would actually be stewards right on the boards. Maybe funds with long-term horizons would align their voting policies to the long-term nature of their investments. Maybe funds would monitor and check management pay. Maybe they would focus on seating directors who added business value and not just former politicians or academics. Maybe the funds would make sure that the right representative litigation was prosecuted where there was a real upside for the shareholders or society in terms of corporate governance reform, and discourage meaningless suits that had only a value for the plaintiff's lawyers. Maybe they would push stewardship and corporate governance policies that were in alignment. They would assess how much capacity they really had to vote, and they would support corporate governance voting policies and structures that would be sensible in light of their capacity to thoughtfully vote. Maybe the mainstream funds, and this is something my respected friends, Jeff Gordon and Ron Gilson wrote about, maybe they would fairly referee disputes between activists and companies and make sure that they were rationally decided in a way that was good for people who had their investments in the company, durably entrusted. Now, what we got was less edifying, and really can be fairly summarized as pushing companies to become corporate Californias. California's got great beaches, some wicked good hot dogs, tacos, other kinds of things. But its governmental system has been really a source of its erosion in the sense of calling constantly for referendums and plebiscites. And that's really what the managed to the market types have pushed for, and they were successful in getting the institutional investor companies to do that. And these constant plebiscites put pressure on company managers to squeeze other stakeholders, lever up, and to engage in the endless cycle of M&A, where you spin something off, then it's bought again, then it's spun off, and then you continue to hit repeat. And certain segments of the pension fund community in particular seem to emerge to just enjoy being, as people would say, a playa, like a playa. They're a factor, they're a thing. People have to listen to them. People hold conferences where they're gigantic shrimp that they can nosh on because they're got other people's money and they throw proposals into the table. And by the way, some of our academic friends love this kind of getting the mustard squirted on their Coney Island dog in public. So what ensued from this great developments? Paying CEOs with options and other forms of equity tied to total stock return. We ended classified boards. We turned withhold votes into pressure tools. We have annual say on pay. Everybody says we should have long-term pay contracts for CEOs that make sure they make. And so we have to put that logic into effect. The institutions insist that we vote annually on pay plans and outsource the voting to ISS, except in a bad year when it's a vote on generalized outrage rather than pay. Then the ISS itself has its spice up the board policies. Let's just throw two or three activists into the mix. Let's set a lower burden to elect less than a full slate because, we really like our jambalaya spicy. And that's what public boards should be about. And then, of course, we vote the index funds and socially responsible funds in line with the active funds to save money. So socially responsible funds vote on social proposals in the same way as the active funds. That makes, that's cool. And we pressure companies to offshore, cut wages. We pressure them not to have prudent reserves. We ignore that these pressures encourage externalities, including pollution and excessive use of carbon. We ignore that this encourages companies to seek to please the market by polluting the political process as a way to survive. That these pressures resulted in inversions of American companies to tax havens that erode the ability of the OECD nations to fairly fund their societies, and also to havens that have less protective corporate governance. These institutional investors, rather than focusing on what really hits investors, like hitting the rocks, failures in risk management, have focused virtually all their proposals and energy around pushing for sell-side M&A premium and making companies more responsive to activist plays. There's been almost no proposals around risk management or any of the things when you think about the scandals and other things that led to Sarbanes-Oxley, Dodd-Frank, or other sorts of things that could have addressed that. None of the proposals are in that area. They're actually to the contrary, to make companies more of a plaything of the market. And then in terms of litigation, did the fund step up to make sure that it was only worthwhile? No, actually, they turned Mrs. Parnes into the Octomom, or Mr. Khan into the Octofather, if he is. Mr. Parnes and Mr. Khan, they're famous individual plaintiffs. The thought was that if institutions refereed this, that litigation would be bought on a benefit to cost basis, that there would be less of it, but the suits that ensued would be meritorious and you would get better outcomes. Instead, public pension funds in particular proliferated as plaintiffs and drove a huge increase in the number of suits that mostly resulted in rents to plaintiffs' lawyers, costs to all investors and society, and virtually no benefits to stockholders. Now, what's resulted from these policies? We have profound inequality. The gain sharing in terms of what share of gains in productivity and profits has gone to workers has plummeted enormously in the US. See the work of Larry Michel in particular at the Economic Policy Institute, which has also been confirmed by recent work by Professor Summers and Stansberry. It's not just the effect of globalization that's isolated the US effect of our particular tilt towards the stock market and institutional investors and away from workers has had a unique US effect. But there's trends in the EU that suggest that convergence with US policies is creating some of the same dynamics. This has hugely harmed our ability to make progress on racial inequality because Black people were not part of the free economy until the mid-1960s. The reversal of the New Deal consensus and the rising power of the stock market has hurt racial progress in a huge way because Black people are much more likely to be in the working class and the lower middle class. They are much less likely to be in the elite stockholder top class. And they have been unable to close the race gap or build wealth for themselves because the share given to working people and middle class people has been so profoundly diminished during the last 40 years. Corporate influence over the political process has grown enormously, polluting our environment and our overall politics. They have systematically used corporate power to denude protection for stakeholders, including workers, consumers, the protection we have against antitrust, and to shield information from the public about important developments like climate change and the dangers of opioids, resulting in huge social harm. They have systematically shifted the risk of their excessive risk-taking to the public, causing the need for repetitive, enormous public bailouts to the corporate sector. And in terms of this year, pushing companies to run on fumes had left corporate America without the resiliency to address the pandemic in any responsible and humane way. Most companies would have had problems in the wake of the pandemic, no question. But we had 10 years of economic recovery and a huge tax subsidy to the private sector. And in weeks of the pandemic hitting, workers were being laid off, creditors were being stiffed because companies did not have the reserves that families are told to save for. They didn't have close to 6 months of reserves. They didn't even have a month's reserve. And then in terms of litigation, it's been a wasteful wave. So to be fair, though, the institutional investor community now bemoans some of these things, and they're talking about sustainable growth. They're talking about the need to respect other stakeholders. And some, like State Street, which probably comes the closest to walking the talk, are actually stepping up on things like corporate political spending. Some of them are voting for forum selection clauses to restrain needless litigation. And grudgingly, they're actually taking into account workers. And I'm hoping they'll actually add the employee name to EESG and call it double ESG so they actually recognize whose money they have. And for several years now, they've been talking about gender inclusion, but they were resisted talking about racial inclusion. But now with the murder of Mr. Floyd and other developments and the fact that the essential worker class is so much more likely to be Black and that Black people have suffered so enormously in the pandemic, they're even stepping up on that. So, but the problem is that most of this rhetoric remains just that, rhetoric. And most of it does not acknowledge that money managers' success in making American companies manage to the market was a substantial cause of these suboptimal outcomes. So we're at a moment of history right now, and it's pretty familiar, right? You got the elite that says, you know, and you see this in the Business Roundtable Institute, okay, we got it, we understand there's a problem now, we get it now. Now, but our bad, but just trust us, leave it to us. And for corporate law academics, think about Merrick Dodd. That was really Merrick Dodd gets a little pass on history, like Chief Justice Roberts gets a pass on the Affordable Care Act when he wrecked it. Think of the Medicaid expansion. Think of voting rights. Merrick Dodd gets to play this game with Adolph Burley, the true New Dealer. But Merrick Dodd was really saying, hey, corporate America kind of understands these things. Leave it to them. There's another school, the Burley school, the Orwell school, the FDR school, the school that I respect, which is, no, when an interest have responsibility in society, when they have a power over society, they have to have obligations to it. And that's what Burley was about. That's why Burley was a brains truster, a key member of the New Deal, and who actually during his lifetime signaled the rise of institutional investors and some of the concerns that they raised. And so I think I'm firmly of what I call the good Adolf school. And he's associated, as many of you know, with Colombia, and the good Adolf being Adolf Burley, that when a powerful group emerges in society, they have to undertake binding obligations to society. And we're in the current predicament because we failed to remember the lessons of history, and we didn't address the power of institutional investors and the resulting effects on companies, and we allowed that power dynamic to be exploited to unbalance the New Deal social democratic consensus that saved us from fascism and communism, and that provided a sound framework for a fair economy. So I think we need to regulate, and there's a couple reasons why. I'll just say that. If you look at what we've done in corporate governance, everybody assumed that we had to have government action. My friend Lucian Fairley said that he has written about the agency cost of institutional investors. And I'll say he has touched on that. But if you read my friend carefully, it's been mostly to say, you can't trust index funds to push companies enough to manage to the market. So be very careful. Do not regulate activists, even make them have disclosure. But in terms of public companies, sure, let's mandate say on pay. Let's mandate how many independent directors they have. Let's get rid of classified boards. Let's tell them that basically they have to manage to the market by having constant plebiscites. And he says, and others say, well, and that's because stockholders are really weak. There's not enough proxy fights. There's not enough derivative suits to really hold them accountable. And we have really weak capital markets. But then we turn to institutional investors. Are there proxy contests against mutual fund boards? Do you really get a choice? Talk about cats and dogs, former politicians. That's your mutual fund board. Do you get a choice over your pension board? If you want to use the Wall Street rule, like they always say, the Wall Street rule is not enough for investors. If you're actually invested in companies, if you're a rich person invested in companies, you have the Russell 3000. You got all kinds of international companies. If you're an American investor who invests in their 401k, your money's kept in till year 60. That's older than, people have to be even more decrepit than I am. You're looking at a decrepit person. You have to be 4 years more decrepit than me to get your money out. Until that time, your only option is to hop to another fund in the fund family, right? But somehow in this space, no regulation is needed. We just trust that they're so aligned. And so there's been no parity of reasoning, frankly, about this. And also we don't deal with the fact that their alignment in terms of pay and other things is not nearly as close as actually of company managers, and their alignments of fidelity don't, no pun intended, aren't as much as people who run companies are with the interests that depend on companies. And our regulatory structure also just hasn't kept pace with things. The Thurston Howell exception hasn't kept pace with the fact that you now have pension funds, charities, university endowments investing in private equity and hedge funds without adequate disclosure. The disclosure requirements around activist investors and other investors haven't taken account of the rise of synthetics and derivatives. Nobody has talked about the changes in how companies acquire debt and the reduced voice of debt capital and what that means for risk. Nobody talks about the cost constraints under which mutual funds compete, and the fact that when we mandated stewardship activities and voting, we didn't actually mandate a certain allocation, and therefore we allow undercutting of the people who do it right by others. And we haven't talked again about the pay. Nobody talks about the alignment of pay in this industry like we talk about others. So the overall effect of this inaction is we get managed to the market policies. They push companies to favor immediate returns over the best interest of their workers and other stakeholders. And it basically results in a pressure to cut wages, offshore jobs, and to lever up and not have prudent balance sheets. And if people say, like my friend Mark Rowe, that people still invest in R&D, yeah, they sure do. They invest in R&D and they invest in buybacks, not as much R&D, but they invest in that. And the stakeholders who get screwed the most are the workers. And that's ultimately us as Americans. And for 99% of us, more of our wealth comes from our job than anything else. And that includes the wealth that we use to save. So for that reason, I think that we have to regulate. And it's not a surprising dynamic where we are. If for 40 years, the arrow up for power is for stockholders and institutional investors. And for 40 years, the arrow down is the power of other stakeholders, particularly workers. It's not surprising that the distributional effects have been in the direction of the powerful interest at the expense of the weaker one. So what I'm going to talk about, and I'm going to skip for the interest of time to the solution, is that it's not enough for institutions to talk about climate change and put pressure on companies when something goes wrong. They need to align their actions with it. It's not enough to say that companies should treat their workers well. We need to see voting and stewardship policies for them that do it. It's not enough to say that they're going to be a fair referee for activist plays. They actually have to step up and have the information to do it and to make sure that they're thoughtfully doing it. It's not enough for them to say they want to be a good steward, but then push on companies so many votes that it costs the companies money to deal with, and no one in the electorate is really thoughtfully attending to them. That's not stewardship. And so I'm going to outline what stewardship might mean in a real world context in the current dynamic. And it's going to be a fast tour through some exciting policy reforms. But before I do them, I want to underscore something, because there's this tendency that people have to say, well, if we only do that, will that fix society? No one is saying that we should only do this. I believe that channeling the power of institutional investors is essential to a 21st century New Deal that restores fairness to our economy. It is not in any way sufficient. Okay, if we don't increase the wages and the voice of labor through labor law reform, living wage legislation, we're not going to get there. If we don't increase consumer protections, if we don't actually revitalize the environmental laws to address climate change, if we don't make the investments in basic research and infrastructure to tackle climate change and to revitalize our infrastructure and create jobs, we're not going to do that. But if we're not, and we also need to require public companies to disclose what they're doing on double ESG and to align their efforts with society's best interest and the best interest of their long-term investors. So we got to do all that. But none of that's going to work if the companies are subject to irrational pressures from institutional investors, and the institutional investors themselves don't have to act in a societally productive way and in a way that is in the best interest of their investors. So that's important context. This is an essential but not adequate part of a 21st century New Deal. So what needs to be done? Well, first we got to actually reverse and go entirely in a different direction from the Trump Department of Labor, which ought to be called the Department of Anti-Labor. Instead of gagging institutional investors who are actually taking into account double ESG factors because those factors are critical to their investors, we need to actually require them to do so. Index funds, in particular, retirement funds in general, have to understand that their investors are invested in the whole economy. They're not long a particular company. So it's very important that there not be increased externality costs that shift costs to other companies, that it raise taxes on workers, that externalize harm to consumers, and that slow overall economic growth. Actually, John Coates has a good paper on this. It talks about basically that we're becoming like the risk of becoming Russia, that where everybody's competing basically just on regulatory gimmicks. The sum total of that is not greater productive economic growth. And to the extent that the funds are actually putting pressure to arbitrage against working people, they're actually hurting their own beneficiaries. And they're actually, in terms of pension funds, cutting the ability of the pension fund to fund itself long-term. Most people need their job. And so these funds need to be required to actually consider these things and to make disclosure. And they should be disclosing how they take these things into account. And consistent with reversing the Department of Labor, all institutional investors should be permitted to do this, to be able to exercise their fiduciary responsibilities and to consider the interest of their investors as on economic and human terms in sustainable growth, in growth the right way that does not involve externalization of costs, that involves fair respect for workers and consumers. And all institutional investors should be allowed to do that. There should be no mau-mauing of them. And in terms of the disclosure requirements for all of them, they should have to disclose how they take them into account. These should be shorter than public company disclosures, but they should track ESG disclosure obligations that should be imposed on all public companies and large private companies. That's a whole different subject. But Senator Warren is right about this, and I've long supported it in terms of companies that have a social impact at least should be disclosing how they affect their employees, the environment, society generally, and consumers. The fact that you don't have public investors doesn't mean that you shouldn't be accountable for that. And that's also going to dovetail with another recommendation I make, because as we've said, many public institutions such as universities, pension funds, and charities are invested through private equity and hedge funds. And they're often exposed to the risk of these private companies through those. So it will actually create a virtuous cycle. Proxy advisory firms, I'm fine with them. They are a symbol of broken regulation. They only emerged because there was the imposition of requirements on institutions to undertake activity they did not wish to take. And so proxy advisory firms arose as regulatory insurance. My recommendation for longstanding is that you can only use a proxy advisory firm's recommendations if they are tailored to your specific form of investing, which means ISS and Glass Lewis should, if they want to give advice to index funds and index funds want to rely upon them, they should be making index fund specific voting recommendations that take into account the stuck-in nature of index fund investing. If you're a socially responsible fund, you should have to be relying on that. And these things should be tailored to what the fund is, or otherwise you can't rely upon it. I think that's just perfectly reasonable. Stewardship, I think there should be requirements to align your votes on corporate governance with your capacity to be stewards. If they really believe they can keep track of all those annual say on pay votes, and they really believe corporations managers should be paid on a year-to-year basis, then they should vote for that. But if they actually do not believe corporate managers should be voted to have year-to-year pay policies, and if they actually would admit that they can't take track of them, then perhaps, for example, they would support putting a quarter of the companies up for a vote every year on a 4-year plan. And so they could thoughtfully vote on it and monitor them. And there's time for requirement for that. And we also need requirements around free riding so that there's a certain level of effort at all funds to avoid undercutting of responsible funds by others who don't do it. We need requirements for stewardship on debt funds to rebalance things and to make sure that we don't just hear the voice of debt capital at the catfish level of the economy when there's an insolvency, but that debt funds are actually pushing governance and structural policies such as avoiding covenant light that help avoid the rocks and help avoid the risks to human investors. Most investors don't just invest in equity, and there's a lot of evidence that activist plays involve shifts in gain, shifts in value from workers and from debt holders to equity. Those things don't help humans. Gains in value help. And we need more of a voice from debt. And finally, on the funds, they need to, on litigation, boards themselves should have to approve any litigation before it's filed, and they should have to approve any settlement, and they should have to make a benefit to cost determination and explain why the litigation is in the benefits of their stakeholders in society and why any settlement is. Then turning to activists, it's pretty simple. We have an antiquated 13D. I don't want to get rid of activism, but we have a 13D that doesn't cover synthetics or derivatives. We have evidence, even my friend Lucian has got good papers on this with Rob Jackson about the amount of tipping that happens to the non-alpha dogs who are sniffing the butt of the alpha dog. And this is all to the harm of public investors and to companies. We are a laggard and a joke within the OECD in terms of our disclosure policies. And any responsible, powerful interest should have some corresponding responsibility. And there is no reason when you hit the 5% threshold, you can't file immediately. And if you can't file, you should have to cease trading. And it should cover all derivatives. And the SEC should develop a standard net long statement that has to be kept current by activists so that it's very clear how actually long the company is. And they should have to be disclosing any investment contracts or other things that bear on the length of their holding. So if they have to liquidate their fund in 3 years, but they're telling you that they're stuck in long-term and they're asking a company to distort its capital allocation and human capital policies for the next 10 years, that you should know that they're just giving you good advice. They're not really in there with you as a corporate citizen. They're just a bystander. And you can take that into account. And see what else we got here. I would also make it illegal for them to tip before their 13D comes public. And I would treat them just like an insider because it's demonstrated that they can have an effect on the markets just by announcing. And one way would be, frankly, to make an obligation that they treat their interest as proprietary and that they do not tip to others until they come public. Finally, in terms of protecting charities, universities, and others, it's one thing to exempt hedge funds and private equity funds from the same disclosure as mutual funds. I agree with that. You can't have them have to disclose immediately their positions, their trading. But there's no reason there shouldn't be standard track record information that they have to disclose that is verified and is subject to fraud liability. And they should have to disclose the terms they give to any investor if they're preferential. And they should have to make disclosures in those areas. And if you put that together with private company disclosure around ESG, you're going to have pension funds, charitable funds, and others who are much more able to invest in this sector with confidence and stop, frankly, getting the worst deal. And we'll also have public investors in general who are able to benchmark the performance of private equity and others against the mutual fund industry and to see what their performance has really been like. So, and finally, to help the industry, I would also put in place a financial tradings tax, which would help reduce fund hopping and help the more long-term managers. And it would also deter day trading. It would deter derivatives trading, which doesn't have economic substance and would be a useful way to fund climate change and could also be extendable to the OECD. And of course, we should close the carried interest loophole by having a real capital gains that applies on a 5-year basis, and to make sure that private equity and hedge fund managers' labor is taxed at the same rate as the rest of us. Now, in my view, none of this will hurt this industry. This industry is federally subsidized. We all have to give it money basically every week if we save for retirement and if we save for college. But it will legitimize the industry and one whose power has long outgrown its expected responsibilities. And in my view, if you do these things in concert with the 21st century New Deal that focuses our economy on sustainable growth, environmental responsibility, and most of all, the fair treatment of workers, that we'll have a more prosperous and equitable America. And we'll actually expand the class of Americans who have the means to invest with this industry for college, for their kids, retirement for themselves, and to enjoy genuine economic security. All of that just involves making sure that a powerful segment of our economy's responsibility be aligned with its powers. Put another way, all that I'm asking is that the haves do a little for the common good. I don't think that's too much to ask. And I apologize to everybody if it was awkward watching someone give a speech on Zoom. And I appreciate very much my distinguished commentator for her patience with my late delivery of my paper. And I'll turn it over to her.
Great, thanks so much, Leo. Providing comments for 20 minutes will be Rebecca Henderson from Harvard. Rebecca, take it away.
Eric, thank you very much. It's my pleasure. I thought I had unmuted. Okay, it's my pleasure to be here and an honor to comment on Judge Strine's paper. Leo picks up the agency issue that Lucien highlighted in the first session this morning, but he takes it, as he says, in a very different direction. He suggests that the heart of the agency problem is that the institutional investors are not representing ordinary Americans that who would like action on climate change, good jobs, higher wages, and to pull money out of politics. I think it's a really interesting idea, but I think there's an important distinction that Leo glosses over in his paper that his argument would benefit from introducing. And that is the degree to which the agency problem reflects a problem of time horizon and the degree to which it represents a problem of systemic risk or collective goods, as John highlighted in his paper in the second panel panel today. What do I mean? Leo seems to oscillate between thinking the fundamental problem is because of agency problems and other issues, institutional investors are pushing companies to focus too much on the short term, that the entire capital markets are overly focused on the short term, and that this creates very bad decisions, notably perhaps not investing sufficiently in workers for the long term, locating plants overseas that should be onshored, and so on. This is an old idea. Certainly when you talk to corporate executives, they will often complain that the markets are too short term. And it's one to which I am at least partially sympathetic. And I think one way of thinking about ESG metrics is that they help correct this market failure, if it is a market failure. Because of course, the conventional reply to this is, well, if there was money in the long term, investors would go to long-term oriented companies and we'd be all set. I spent the first 20 years of my career studying why it was so difficult for large organizations to change. And so I put more credence than most on the importance of standard operating procedures, ways of thinking about the world, and existing metrics in shaping strategic choices. And so to me, it is quite plausible that there are long-term opportunities that firms are not picking up that would benefit other stakeholders. And indeed, that the kinds of policy recommendations that Leo has laid out for us that would have the effect of slowing the capital markets down and giving corporate managers a little bit more space might indeed be value enhancing for all stockholders, and particularly for employees of the firms and for other stakeholders in the society. But Leo is making another really interesting point, I think, which is he's pointing to externalities. That is, he says things like the whole economy would be better off if we paid employees more, and the whole economy would be better off if we tackled the problem of climate change. And this is really echoing Professor Gordon's point in his second paper, which is we're facing these massive systemic issues which, and this is the reason I think the distinction is important, may not be in the interest of any single firm or indeed any single investor to correct. So here's my worry. When we say fix the agency problems, it will have, so that institutional investors better reflect their ultimate owners, I'm completely on board. I think it will get you those problems that are essentially long-term problems that perhaps we haven't been focused on sufficiently. It's not clear to me that it will get the collective action problem. To be specific, I have money in a 401k and I care enormously about climate change. I'm a verified tree hugger. But do I want the firms in my portfolio to invest against climate change if it reduces their returns? Well, I do. But, you know, I am a very privileged person with deep financial resources. It's not clear to me that if I'm, you know, working 2 jobs and really dependent on my savings and my retirement funds for a healthy retirement, that I'm going to be willing to make that trade-off. So I think that's an interesting question that we really must keep in mind here. And in order to address it, I go in 2 directions. One is where Leo opened by saying, or anyway, Leo raised this point, which is many of these problems can only be addressed by public policy. That climate change is a public good, decent wages and real stable working conditions are public goods for the whole society. We need good public policy, check. What that suggests to me with regard to this conversation is that every asset owner who cares about these externalities has very strong incentives to, in Leo's word, make sure the firms they invest in are no longer polluting politics. And if there's one thing we would try and get alignment on, it would be to try and pull the kinds of resources out of politics that have led to 70% of Americans now believe, and this is before the pandemic, that the political process is basically rigged in favor of those with money and power, which is very destructive. And we could talk more about the corruption of politics, but it is very real. So I personally would love to see institutional investors pushing hard against this issue of political spending and pushing the firms in their portfolio to contribute to data to centers like the Center for Political Accountability, so that we have a really clear sense of what they're spending on who and why, and then asset owners can have some sense of what's going on. So let's add that to ESG. The other issue is, of course, asking whether we can have collective action. And this is the issue that John raises in his paper. Massive systemic risk to the long-term health of the economy. Everyone has an interest in addressing it. Can we somehow trigger the collective action that is necessary to address it? Is it appropriate for the big fund managers to work with each other? Bracketing antitrust concerns, of course, which are a major issue, but assuming that antitrust concerns are not an issue, and we clearly need to understand that more, should we be excited when institutional investors work with each other to push the firms in their portfolio to address an issue like climate change or living wage? And here I think Leo adds something really important, which is individual investors cannot solve this collective action problem themselves except through politics. Certainly not through their investments, without a lot more choice in the retail investment market and mandatory disclosures. Perhaps we could argue that institutional investors are exercising their fiduciary responsibility by working with other investors to address these major systemic risks. That every one of their investors would benefit enormously if we solve the problem of climate change. And thus it is indeed in their fiduciary duty to address this problem. Now, one concrete example of that is the stance that Hiro Mizuno took when he was chief investment officer at the GPIF, the Japanese pension fund. As I'm sure you're aware, the Japanese pension fund is the largest pension fund on the planet by some measures, with $1.7 trillion under management. And Hiro came to believe that he had an overwhelmingly fiduciary duty to address these problems of systemic risk, particularly social inclusion and climate change. And that it was incumbent on him to start pushing his asset managers to make progress in this direction. And he joined forces with other asset owners in groups like the Climate Action 100 to sort of kind of facilitate this collective action. So we do see at least some asset owners, or at least some institutional investors who represent ordinary people, sort of pushing in this direction. As he pushed, Hiro found a couple of problems, which let me just put on the table because I haven't seen them discussed during the course of the day as much as I would have expected. One is the question of who's going to develop the information to have these kinds of conversations with every firm in their portfolio? Who is going to have one-on-one conversations? Every asset manager, of course, has a deep incentive to free ride on the efforts of all the other asset managers. Does that mean that we should rely more on the rating agencies or less? Does it mean we should have a public body that collects the kind of information necessary to address these public goods issues and makes it freely available to all asset managers? How do we think about supporting the strong temptation that every asset manager will have to reduce its investment in this area? And we heard from BlackRock that they have a team of 46, and it's the largest team in the industry, and that's fantastic. But 46 people? Like, that's it? You know, for an economy of this complexity and conversations of this kind of nuance. So I wonder if, in addition to some of the legal reforms and policy ideas that Leah raised, whether we need to think very specifically about where the information will come from and who will pay for its provision. Eric, I think that's it. So I'm happy to finish on time and leave some time for Q&A.
Excellent. Thanks so much, Rebecca. I appreciate it. Great comments and a terrific presentation. Leo, do you want to say anything in response to Rebecca, or shall we?
I just want to thank Rebecca for her fantastic comments and for bailing me out, Rebecca, because you and I have a shared view about corporate political spending. And in trying to be somewhat on time, Eric, I left out, as Rebecca knows, a part of my paper that actually advocates specifically that for stewardship in this, and that would require corporate political spending to be approved by stockholders by a supermajority, and that any spending plans that were approved by stockholders have to accord with the company's ESG values. And so I fully support that, and I agree with Rebecca. And I also want to say that I agree with Rebecca too about the collective action problem. And I focused today, Rebecca, on the stewardship of institutional investors. But as you know, I have a paper that tries to move the dynamic, move the needle a little bit on all the things. And it actually goes a little bit to your point about information. I think that it's tremendously important that we update the mandate of the Securities and Exchange Commission to give them the authority to require disclosures in the area of ESG, and to allow them, Rebecca, to consult with agencies like the EPA and the Department of Labor so that they have input from them. And I think if we can do that and actually cooperate with some of the international standards thing, we'll begin to close a little bit that information loop that you're talking about. And that will help with this stewardship gap. And I also want to find a thing, I think Rebecca's very on point about the antitrust issue in this sense. People mau this industry and try to gag them from cooperating. They don't apply the same thing to any other industry. And the reality is these BlackRock and State Street and Vanguard and Fidelity are fierce competitors, but there's no antitrust reason why they can't have a center of the plate investment institute like the CII that would a part of the CII that would actually collectively focus on externality reduction, real economic growth, and climate change. I don't think that proposes a competitiveness reform. I think there are some, frankly, academics, Rebecca, plaintiffs' lawyers, and activist investors who discourage that because it's not in their interest. But I think as an academic community, putting to rest this myth that it's some sort of antitrust problem would actually be quite useful. And I think with some collective action along those lines, it could rationalize some of the stewardship resources. And part of why I did try to recommend in an imperfect way some minimum, Rebecca, of investment in stewardship by all funds is to cure that problem of the free riders and the undercutting. But I really appreciate your comments. They were tremendously helpful.
Excellent. So we have a few minutes for Q&A, and I've already seen the Q&A chat room lighting up. So if you are in that chat room and you would like to relay that question personally, please raise your hand. I also, one of our folks who's in the participant room, Ron Gilson, has asked to ask a question, and he's disabled from raising his hand. So Ron, if you are out there, let me start with you.
Okay, well, I think I'm unmuted now.
Yeah, you're
okay.
good.
This is just a quick one, and it builds off of Leo's comment that we didn't learn the lessons of history. Leo's not as old as he makes off. Some of us are even older. The Investment Company Act of 1940 was adopted 11 years after Wyatt Earp died in Los Angeles, not in the gunfight at the OK Corral. The point I want to make is Leo's description of the bad moves over the period starts before the shift from defined benefit plans to defined contribution plans, the shift from giving the responsibility for making investment decisions from people, from companies that had an obligation and had the capacity to hire good people and push them into mutual funds. And it's worth remembering why that happened. It happened because we stumbled on the fact that companies had massive underfunded past service costs, and we weren't requiring them to put it on the balance sheet. Once we passed ERISA and required it to go onto the balance sheet, the good news was all of our long-term companies terminated their defined benefit plans and shifted them to defined contribution plans. I make this not to shift the blame, because there's plenty to go around. But this notion that there was a magic period in which management was local and worried about their employees. Boy, when those past service costs had to go on the balance sheet, they sold the workers down the river. So it's not. My point isn't Patrick quoted Twain earlier in the day. There's another one. History may or may not repeat itself, but sometimes it rhymes. And what you're describing is a rhyme from the set of events that happened way before takeovers, way before there were significant institutional investors playing the role that they play now, so that as we think strategically, the history we're talking about, I think, is too short, and there's nobody in this game that's got a white hat.
Oh, no, Ron, I totally agree with you. So I didn't mean part of, if you saw the difference between the system as it is now and the thing really was, it had the point about most workers were invested through pension funds and stuff. So I totally agree with you on the arc. And I don't mean to villainize. I mean, there are people in this who ought to be villainized, but I don't think that the shift is necessarily entirely responsible for that. I don't think, for example, the people who did the proxy voting mandate in the 1980s understood the implications of what they're doing. I don't think that they were evil, but I think they were short-sighted. So I fully agree that this is a long arc. And I take it we both agree that the regulatory structure is way outdated and doesn't actually match the system that we have.
Well, and because let's remember, in when the gunfight at the OK Corral took place, no one had automatic weapons.
No, and that's what I mean. I mean, even the notion that our disclosure regimes don't cover derivatives and synthetics is crazy, right? And the idea that it takes 10 days to report, that was in 1967, the summer of love, when you actually had to prepare a document and deliver it to Washington. And the fact that we haven't updated any of this, I think, is part of what we're saying, right? Is that there ought to be a 21st century regulatory regime to deal with the 21st century economy. And you're saying that my point about a 1970s era regulatory regime, I'm probably wrong. It's probably more like 1950.
And the problem we need to confront is less the regulation of an investment advisor, investment funds, but how we want to save for retirement. Because we ducked that after World War II.
Oh, no, but that's one narrow thing. I do not think that you can ignore the shift in gain sharing in terms of the importance of those stock market and institutional investor powers on that. And that if Americans if you don't get enough pay, you don't get to save. I mean, the 401k threshold is already a reproach for most ordinary people, even well above the median income. No person who's an ordinary person puts in close to that level. And so if you want Americans to save for retirement, they need to actually get fair wages.
No disagreement.
So next on the queue, we had Marco Becht. Marco, are you still out there?
Yes, I am. So we're obviously going to talk about UK in the next session, but I thought, given the comment that Leo made about collective engagement last, I thought I might just ask a question about it. Of course, in the UK, you now have the Investor Forum, which seems to work very well. And you also have in Canada, the Coalition for Good Governance. So there are other countries and neighbors outside the US that are practicing precisely what you called for. So is the absence of these kind of mechanisms or initiatives in the US, is that due to the law, or is it the politics, or what is it? You probably know the answer, but
Marco, you couldn't be more right. And Marty Lipton and I and others who are interested in sustainability have pointed to the institutional investor community, to the Investors Forum in the UK as an example. I think one of it is that the origins of the UK institutional investor community are quite different from our own, and they come more of a pension fund dynamic. It's not surprising that the Council of Institutional Investors, which has a lot of pension funds, particularly public pension funds, is a collective organization. Our mainstream mutual funds are fierce competitors. And so I think in the US, that's always an odd thing. And as I said, I think there's been an exercise in academic and political intimidation of the space. People affiliated with the hedge funds have really put it in the ear of the mainstream mutual funds that if they collaborate, they're at legal predicament. They're not necessarily inclined, Marco, to want to collaborate, because one of the most foolish pieces of literature I see out there is the idea that these folks the index funds are in some cahoots with each other. They undercut each other all the time. It's one of the real stewardship issues. And so it may be a great theory because they're co-invested, but they're fierce competitors. So I think we need to get around it, but there are some really social and political dynamics that I think are different in the UK. I think the Investors Forum, though, is a good model, and we ought to be learning more about it. I think some of the stewardship efforts, for example, I've written an article about the Comp Committee becoming a broader workforce committee, Marco. And, one of the inspirations for that, besides my own fascination with, treating workers better, is the move in the UK, which I believe the Investors Forum supported, to have a board level attention to the workforce. So you're so right that we need that international lens. And one of the great things about this institute is having that. For example, I'll just put a point on it. There's a lot of silly, by some people I admire, literature that stakeholder governance really can't work. And it's like Germany and Scandinavia and most of the OECD does not exist. and they don't realize that, there are other models out there than the US model, and that they're pretty tolerably successul.
I mean, as a German, I have to point out that Dieselgate did not happen in Britain. So.
Oh, no, I'm not saying everything's perfect, Marco. What I'm saying, though, is in terms of a high functioning market economy with a model of corporate governance in which there is more of a multi-stakeholder thing, we have many models around the world, and the US is actually more of an outlier, as you know. And part of the benefit of the Institute is actually to have that collaborative, kind of input. And we in the US are often wear blinkers. And, just like the Brits don't understand that the name soccer is their own, that we in the US sometimes don't understand corporate governance outside our borders. Hey, Eric, Michael Schreg has asked a question about how on earth I reconcile something with an opinion I wrote in 2018. Does Michael remember the name of the opinion?
I'm not sure. I don't know if Michael's mic'd up or not.
I would just say this to Michael. When I'm a judge, I apply the law of my state. When I write, I can speak about what things ought to be. And I believe it's really important to understand what the is and not confuse it with your ought if you actually want to move towards your ought. So it may be that I wrote some opinion that is at odds with my normative views, but that's because I was wearing a robe and I take that very seriously.
Maybe I can jump in and ask a question to both you and Rebecca. Lucian's first panel dealt an awful lot with trying to think about analyzing agency costs at the index fund level. And then Jeff's was, very much engaging this sort of question of systematic reforms and what was and was not possible. In addition to, what in the US certainly was a big deregulatory movement starting in 1980 and going through the 2000s. To what extent does our ability to actually solve agency problems sharpen incentives of managers in the direction of shareholder return maximization? Does that create a problem for us? Is there a role for agency cost if in fact the solution here is going to be trying to figure out how institutional investors and corporations themselves are going to engage in some form of self-policing and raising the tide general?
Well, I'll let Rebecca go first.
So I just published a book called Reimagining Capitalism in a World on Fire. And to many people, when they hear that, they're like, Rebecca, business saves the world? Like, seriously? And so to your point, Eric, you could imagine a world in which we reduce agency costs and the pressure on firms to get even more focused on the bottom line would go way, way up. As I said, I think there's an important class of investments that are in fact NPV positive, that if we had investor pressure focused on the longer term and on a wider range of metrics, would indeed come up and be supported. But in the large, might it be a problem? Absolutely, it might be a problem, because so many of the problems we face are fundamentally collective action problems and can only be solved through public action. And at the moment, we have an equilibrium where every firm has an incentive to try and distort the political process in their own favor. And that's not a great equilibrium. And so, pressure to do more of that would be hugely counterproductive. So yes, huge issue. But that's why I keep jumping up and down and saying collective action problem. Is it really maybe it's in my fiduciary duty to act collectively.
But I mean, it's also a question, right, of the better angels of our nature. And if you play like I hugely love the game of soccer and I love the game of basketball. If you play a game and the referee doesn't enforce the rules, the game does not move in the direction of the most sportsmanlike players. By the end of the game, everybody's kicking each other. And when you mention agency cost, Eric, I think what we have done is we've reduced certain types of agency costs, those where there's any incentive, to be honest, to put anything other than the marginal traders' interest first. We have ignored the actual, diversified investor problem. We've ignored the creditor problem. We've ignored the fact that the residual claimant model is so primitive and so non-descriptive of the real world that it ceased to be taught. What I mean by that is, if we had a summing up every 20 years and the stockholders could just get the residual after all the workers in society and the externalities were paid, it might work as a model. But there's probably no group of stakeholders that actually collects more on an ongoing basis than the so-called residual claimants and sticks the rest with the rest. And so I think what we're talking about is, I believe with product market competition, Rebecca, that's intense, that already reduced agency costs, frankly, much more than anything else. And we keep forgetting that. Competition. Annual elections in Delaware the American, I mean, I've written a thing called the Soviet Constitution problem in corporate law, which is that everybody would talk about Europe, actually, Marco, about how Europe was stockholder heaven and the US was like the stockholders were weak. And it was like saying that the Soviet Constitution was the greatest, exemplar of civil liberties because you read it on his face. And I think, Eric, with the vibrant takeover markets that we have in the US, the vibrant election process, the collectivization of the industry, the product markets, it's very difficult to see how companies can survive if they're not profitable. No worker wants to work for an unprofitable company, but these externality costs and the risk of doing things the wrong way, I think are what requires, I think Rebecca and I agree, to address that. And that's where the corporate political spending comes in. I did an article called Corporate Power Ratchet. People forget Lewis Powell. Lewis Powell should be associated with Milton Friedman at all times because Lewis Powell, Justice Powell, called for the weaponization of corporate resources to go to war on the regulatory state. And it was the combination of the Friedman doctrine and loosening the rules of the game that brought us here. And I think what we're talking about, Eric, is having a strong accountability structure for managers for profit creation, but one that's rationally aligned with the real interest of investors. And that gives them a little bit room. I just have a hard time seeing how they're going to loosey-goosey. And in the United States of America, we have the lowest level of self-dealing and corruption anywhere on the earth. That is the pride and joy of our corporate governance system. And all stakeholders are aligned in that. No worker, no consumer wants management theft. And we police that very strongly in the US. And so I think there's really little risk that we're not going to focus on competitiveness in the right way. But if we don't do something about competing on the wrong dimensions, then we're really eroding anything. And frankly, we're opening the door to really nativist division. By not having an economy that works for everybody, the white working class is divided against the black working class, when if we frankly paid everybody more fair wages, we would close racial inequality in a non-racially direct way. And we would ease white economic insecurity, which would reduce that. And so what we're really talking about is whether we can move to a sort of what I would call a virtuous incentive system process that focuses on sustainable wealth creation. No one is talking about making the for-profit sector into a non-profit sector. No one.
Great. So that went by fast, but we are out of time. I guess as Wyatt Earp said, fast is fine, but accuracy is everything. So I want to thank both Leo and Rebecca, and I apologize to those of you who are in the queue and we weren't able to make it to you. We're going to be reconvening at Eastern time, anytime, 25 after the hour. We're going to be taking about a 6-minute break. Thanks a lot.
Thank you all. Thank you, Rebecca. Thank you, Eric.
Thank you.